Okay, let's talk about support and resistance. It's one of the very first things any trader learns. It's in every book, every course. It's supposed to be foundational. But what if I told you that this simple concept is actually one of the biggest, most misunderstood traps in all of trading? Let's dive in and see why it trips so many people up.
I mean, think about it for a second. You've been there, right? You draw this perfect line on your chart. Price bounces off at once, maybe twice, you're feeling good. And then the third time, it just blows right through, stops you out, and then makes the move you predicted all along. It's maddening. So why does this tool, which feels so logical, seem to fail so consistently? That is the exact question we are going to answer right now.
You see, to understand why it fails, we have to first understand why it's so darn appealing in the first place. This is really the heart of the support and resistance trap.
And the appeal is so clever, isn't it? I mean, first, it's visual. You can literally draw a line on a chart. It's simple, no complex math or weird indicators involved. It feels objective, right? Price either hit the line or it didn't. And here's the real kicker. It seems to work, just often enough to keep you coming back. That little bit of reinforcement is what keeps you hooked on a flawed idea. But here's the fundamental truth that changes absolutely everything. Markets don't see your lines. They don't care about them. They aren't physical barriers. A market is just a giant machine for matching buyers with sellers. It cares about one thing and one thing only: orders. So the only question that actually matters is, where are the orders? Because that is what moves price.
And this brings us to a really critical point. That exact same level you're looking at on your chart, it's being viewed in two completely opposite ways, depending on who's looking. Let's break down these two different perspectives.
And here it is, the core conflict. The average retail trader, the person learning from all those books, is taught to see a level as a barrier, a wall, something that's going to hold the price. But institutional traders, or smart money, they see that exact same level as a magnet, a place that price is almost guaranteed to be drawn to. Why? Well, because that's where all the orders are hiding.
This table really breaks it down perfectly. For the retail trader, the purpose of the level is safety. Their action is to trade at the level, and their whole mindset is reactive, just waiting for something to happen. For smart money, that's safety, all those stop losses, that's their fuel. Their action isn't to respect the level, it's to push price through it. Their mindset is all about engineering a specific outcome. One person is playing checkers, the other is playing chess.
Just let that sink in for a moment. It's the same level. The only difference is the purpose. The level itself isn't the problem. The conflict comes from two groups interacting with it for completely opposite reasons. One group's shield is another group's target.
So, let's get down to the nuts and bolts. Why do those clean, obvious, textbook perfect levels fail so often? Well, the answer isn't just random luck. It's mechanical. There is a very specific process happening behind the scenes.
The entire secret is a concept called concentrated liquidity. Sounds a bit technical, but it's actually pretty simple. When a level is super obvious, everyone sees it. And when everyone sees it, they all tend to do the same thing. They place their stop-loss orders just on the other side of it for protection, and they place their breakout entry orders to catch the move. All of those orders together create this giant, juicy pool of liquidity.
Now, this isn't an accident. This is a process. It's liquidity engineering, and it usually follows these steps. First, an obvious level forms on the chart. Second, that predictable cluster of stop and breakout orders starts to build up around it. Third, price is deliberately pushed right through that level. Fourth, all those orders get triggered and that liquidity is captured, like fuel for a rocket. And only then, after the fuel has been taken, does the real move actually begin.
This right here, this is the key mindset shift. When you see a support or resistance level get taken out, your first thought shouldn't be, oh, the level failed. Your first thought should be, the level just did its job. You see, violating the level isn't a failure of the concept, it is the entire function of that level in a market that runs on liquidity.
Okay, so right about now you're probably thinking, but wait a minute, I've seen levels hold perfectly to the pip. And you're absolutely right, they do. So what gives? Why do some levels get destroyed while others hold like a fortress? Well, the answer usually comes down to this. Was the liquidity already taken? Levels often hold beautifully after all those stops have been run and the trapped traders have been shaken out. Price respects levels once the real business is done.
All right, so we get the problem, we understand the trap, but how do we start thinking differently? How do we adopt a smart money mindset? Let's build a new mental model for how to look at these levels.
First things first, you have to completely stop asking the old reactive question that gets everyone into trouble. You have to stop looking at a level and asking, will this level hold? And instead, you're going to look at that exact same level and ask a totally different question. Who is trapped here? Where are all the stops? Where are the breakout traders getting suckered in? This question forces you to see the chart as a map of liquidity. So, let's just redefine this whole thing right now. Support and resistance is not an entry model. You don't use it to find a place to click buy or sell. Think of it as a liquidity map. Its only job is to show you where other traders are most likely to be vulnerable and trapped.
So how do we actually put this into practice? Well, first, you're going to draw your lines, but not to find entries. You're drawing them to map out where that pool of liquidity is building. Second, completely flip your expectations. You need to expect the level to be violated. Third, you wait. You look for the true market reaction after that liquidity has been captured. And finally, remember, this doesn't happen in a vacuum. You always have to analyze these levels within the broader context of what the overall market structure is doing.
If you only take one single thing away from this explainer, let it be this. Levels don't fail. Our expectations of what those levels are supposed to do, that's what fails. The market is just being a market, efficiently seeking out and facilitating orders. Now, we've thrown the word liquidity around a lot today, but that term itself is a huge minefield of bad information. So, coming up next, we are going to pull back the curtain and reveal what liquidity actually is, what it isn't, and why understanding it correctly is the real key to reading the market. You are not going to want to miss that. Join us for our next explainer.